my biggest loser number 4. The company name is Impinj, I-M-P-I-N-J, Impinj. The ticker symbol is P-I. I first picked Impinj for Motley Fool Rule Breakers on December 21st of 2016. A few days before Christmas. Not a very good stock to put under the tree that particular year, because at the time it was at $38.33, and today it's down at $16 a share. It's down 58%. So what is a reflection that I have about Impinj? Well, this is a company that has developed a platform for RFID technology. Those RFID chips that you see those tags put on, well, everything from packages to devices to keep track, inventory management, tracking where things are going, or maybe at your corporation you have these little tags placed on, I don't know, underneath the chairs so we can figure out where all the chairs are in the conference rooms. There are multitudinous ways of using this technology, and this company has built out a platform to help you as an IT manager kind of manage all of your assets. But this company, now having lost 58% of its value in the last 2+ years, is down to just a market cap of only about $340 million. So lesson number 4 is when you have a company get crushed down to be that small, I would typically suggest that you refuse to add to those positions. Ignore crushed microcaps. Not only is this a stock pick of mine in Motley Fool Rule Breakers, but I also personally bought it for one of my children's accounts. And so I've taken this on the chin just as much as anybody else, and I'm not looking to add to that position. Now, the reason I'm saying that and highlighting this is because a lot of people, when they see a stock go from 38 down to 16, they start thinking, well, I liked it at 38, and 16, heck, if it just doubles back to 32, it's still below my cost, but it would be a double from here. And so sometimes people get excited when companies lose this much value and they start thinking, this isn't a penny stock, but this is really prevalent in penny stock thinking. They start thinking, yeah, it wouldn't take a lot to double from here. Maybe I should buy some more. And while that can be true, and we have had some all-star performers bounce back, in fact, 2 years ago when I did David's Biggest Losers Volume 2, I highlighted RH, also known as Restoration Hardware. The stock had dropped from 93 down to 30, which was a huge loser 2 years ago. Within the following year, it bounced back from 30 to 95. Today, I'm happy to say it's at 127.5, up 4 times from when I did David's Biggest Losers Volume 2 years ago this month. So it is possible that some of these companies, especially ones that are more substantial companies with maybe a brand that people recognize, they probably have a better bounce back opportunities than some of the others. I'll give another quick example. A year ago on this podcast, David's Biggest Losers Volume 3, Under Armour was on the list. Under Armour had dropped from 39 down to 14. Well, over the last year, it's up 29% from where it was a year ago. So some of these bounce back. In my experience, it's probably the bigger, more branded companies that do that, not the Impinjes of the world. Now, I still hold my Impinj shares. It's still a part of our active rule breaker service. I sure hope it comes back. But I would typically, lesson number 4, ignore these crushed companies that get down to micro-capville. Now, I do want to point out one other quick thing about Impinj before we go to number 5. And that is that this company has had decelerating sales growth. So when we first picked it back in middle of 2016, sales were growing about 50% year over year. Like from the previous year's quarter to that quarter, it was up 50%. Then the following quarter, sort of the end of 2016, that dropped to 49% year over year. Then the following quarter throughout 2017, it went 47%. Then the next one was 31% growth. Then the next one was 5% growth. And then 6 quarters or so after I'd first recommended it, sales actually decelerated to the negative, down 20% from that quarter a year ago. So especially when you see sales growth decelerating and going negative for smaller cap companies, that is a really bad sign. Of course, not something I was expecting at all. Very disappointing. Makes me wonder about the RFID technology, period. And we probably need to reassess this. But anyway, that's where Impinj is, my 4th biggest loser, with a couple of thoughts you can take away about Impinj. To summarize again, ignore these crushed companies once they get to be so small. And 2, plummeting sales, an especially bad sign for small companies.